Good afternoon, Mr. and Mrs. Hess. How are you doing today? Perfect. Perfect. Okay. The most important question of today is, how is retirement going? Excellent. Excellent. So John, there's no regrets selling the manufacturing business? Not yet. All right. And Mary, are you sticking to the plan of spending more time with Jack and Eugene and Beth? Excellent. Excellent. Well, today we're going to be handing out and delivering to you your financial plan. So actually, let me just hand that to you guys right now. John. There you go, Mary. And what I would like to do is spend today reviewing some specific recommendations that I've highlighted in that plan. All right, there are some things that I think we want to address. And at the end, I've sort of summarized everything into an action plan to keep it organized. All right. Now, quick question. Has anything changed in your guys' financial situation that might impact anything that we will be discussing today? Perfect. Okay, perfect. Now, before we begin, let's just get grounded on your guys' goals from our last meeting last time. Kind of on the first page, I summarized it. The first goal was to review insurance contracts and discuss the implications of purchasing long-term care policy. So we're going to start with that today, kind of a review and a walkthrough of your insurance policies. Second, you asked us to recommend a diversified portfolio that meets your investment needs and expectations. So we're going to drill into that area second today. And then finally, you asked us to reduce personal income tax and any estate and gift tax liability, and then just to make sure all your estate planning documents are in order. So we're going to focus on that third today. And then, like I said, at the end, I've put together sort of an action plan that organizes all the things that we're going to talk about today. All right. Any questions before we begin? All right. Excellent. One of the things I did first was sort of take a look at your guys' financial circumstances. We reviewed your accounts, your cash flow, and like I said, a review of your insurance policies and investment portfolio. There was one thing that jumped out at me. After reviewing your accounts, can you tell me a little bit about your thinking regarding your certificates of deposit at the central savings banks? Okay, so sort of for emergencies, right? Unexpected expenses, surprises. All right, perfect. All right, the reason I brought that up is my concern is that's a large amount of money that you have deposited at the central savings banks. Between your checking account, your savings account, and your CDs, you greatly exceed the FDIC insurance coverage limit of $250,000. Now, normally a bank failure is pretty rare, but given the high interest rate environment that we have right now and the fact that we just saw bank failures at Silicon Valley and Signature Bank, I'm a little bit concerned that you might have a little too much exposure at the central savings bank in case it were to fail. Now, I don't want to scare you, but my first recommendation is really to kind of divest a little bit and spread that risk outside of central savings bank. Now, John, you mentioned that this is kind of for emergencies, but what I would recommend is actually us transferring some of that money to a brokerage account, setting up a dedicated emergency account, and putting in 3 to 6 months of living expense into that account. In fact, I would recommend you invest that in a high yield money market fund. You're going to get a similar interest rate that you are to the CDs, but now we're going to divest some of that exposure out of the central savings bank and into a brokerage account. Does that make sense? Perfect. Yep, and then it spreads it out into another account. Yep, exactly. The other thing I would recommend is actually adding a transfer of death beneficiary to your CD. I know we're going to talk about estate planning a little bit later, but one of the things you want to do is avoid having that go into probate in case you pass away. By putting a transfer on death beneficiary and setting that to Mary, if anything were to happen to you, that account would transfer directly over to Mary without having to go through probate. So since we're talking about the CDs, I want to kind of put that out there as well. I'm divesting it a little bit and then adding that transfer on death beneficiary. Does that make sense? All right, perfect. All right, so let's jump into the insurance policies. The first thing I want to talk about is the homeowner's insurance on your primary residency. I'm a little bit concerned that the face amount on this policy is only $400,000. Normally, at a minimum, you want the face amount to cover 80% of the fair market value of your policy. And in this case, that would be $620,000. The reason is if you had a claim against your house, a pretty large one, your insurance agent would not be covering the full loss of that claim minus your deductible. They would only be covering a percent of that claim. And in your financial plan, I actually put some examples of how much they would cover in certain circumstances. In order to fully sort of cover the risk you have in your residency, you need to get that up to at least 80% of the fair market value of that home, or $620,000. So we do want to raise the coverage amount on that primary residence. The other thing I noticed is I didn't see a flood insurance rider on the vacation home. And given its proximity to the Connecticut River, if the river actually flooded and did serious damage to the vacation home, without that flood insurance rider, your policy wouldn't cover any of the damages. So we definitely want to add that flood insurance rider to the vacation home as well. Any questions on those two items? Okay. Kind of moving on to the auto insurance policy. I reviewed the policy for the car. I did not see a policy for the SUV or the boat. Do you guys have both of those vehicles covered? Okay, perfect, good. I just wanted to make sure. I also noticed that your deductible was a little bit on the low side at $350. Given your guys' financial position, there is an option of raising those deductibles to maybe $500 or $1,000 and getting some, realizing some premium savings. So there's an opportunity there if you just want to take on a little bit more risk to sort of reduce your premiums a little bit further. All right, perfect. Now the most important question I have when it comes to property insurance is the inverted Jenny stamp. Do you guys have an insurance policy specific for the stamp? You don't. All right, we're going to want to address that. You're going to want to insure that stamp with a personal property policy. The way we're going to do that is you need to go out and get it officially appraised. Once you receive that appraisal, you'll be able to talk to your agent and have a policy set up to cover that stamp. And I can't stress that enough. I actually had a grandfather who spent his life collecting stamps. My uncle inherited them, put them in the basement, and then proceeded to have his basement flood. And he actually lost part of the stamp collection, and it was horrible. He felt horrible, the family felt horrible. You have $1.4 million invested in that stamp. We want to make sure we get a policy put and cover that investment right away. All right, perfect. The other thing I noticed is I didn't notice actually a umbrella policy. Do you guys have an umbrella policy? What is an umbrella policy? An umbrella policy provides a little extra liability in case you guys get sued. You guys have a net worth of $13 million, which unfortunately makes you a potential target of different types of lawsuits. By having an umbrella policy, it provides a little bit more extra coverage in case you guys get sued. Now, this may cause you to have to increase your liability coverage on your home and your auto insurance. But I definitely recommend a umbrella policy in the range of $1 to $3 million. They only cost a few $100s per year, and they sort of provide that extra level of security. Yep, exactly. Perfect. Okay, and I've got some information, and I actually have some quotes for umbrella policies in your plan material there. All right, excellent. All right, so moving on to healthcare. So we got a great opportunity here. We're right in the middle of Medicare annual enrollment. From reviewing your policies, I noticed you were enrolled in Part A, Part B, and Part D, but I didn't see a Medicare supplemental policy. Are you guys aware of some of the gaps in Medicare coverage today? Okay, good. All right. Yep. Yes, we will want to address. I would recommend addressing some of. Yep, I would recommend getting some extra coverage to address some of those gaps. Now you have two options. You can either stick with your existing policies and add on a Medicare supplemental policy, or we could consider sort of packaging them all up and getting a single Medicare Advantage policy. And this is actually also known as Part C. Yep, a Medicare Advantage, there are different options, but many of them include both A, B, D, and MedSup into a single policy. Yep, that is correct. Yes, yep, they have insurance premiums as well, so they have costs associated with them. But I actually put a few examples, I put examples of both Medicare supplemental policies coverage in there, and then I put a couple examples in there of Medicare Advantage as well, so that you guys can kind of compare and contrast the coverage as well as the cost between those two options. Yep. Yes, I would highly recommend, as part of annual enrollment, either adding Medicare supplemental or flipping all over to a Medicare Advantage policy. Excellent. But perfect. All right, now one of the things you did inquire about was long-term care insurance. This fills a lot of the caregiver gaps. For instance, if you had to get put into a nursing home or a skilled nursing facility. Some of the things we talked about earlier, some of the different things, flex points we need to consider is the elimination period. So how long do you have to wait before coverage kicks in? We talked about some policies have maximum daily benefits. Some of them only cover a specific length. These are decisions you'd have to make as far as sort of what are the different flex points you'd want there. We talked about maximum benefits. So there's some policies that have maximum benefits. And I'm definitely recommending you get inflation protection. And so in your packet, we put together some options and corresponding cost estimates for your review. We've broken them into three categories. There are the traditional long-term care policies where you're basically just buying a long-term care policy. I also have in there some hybrid long-term care insurance policies. And those are the ones that pair the long-term care policy with a life insurance benefit. So it provides both the long-term care coverage and a death benefit for your beneficiaries. And then finally, I took a look at your existing life insurance policies, and there is the opportunity to put a long-term care rider on your existing life insurance policies. And so what that allows you to do is actually use some of the death benefit to pay long-term care needs. Yep, while you're still alive. So I actually put in that cost as well. It's a little bit more premium, but you can add that long-term care rider to your existing life insurance policies. Yep, and I put different elimination periods in there, different flex points are in there as well. And what I would recommend is take them home, review them, compare the coverage that you get with each of the policy and what the out-of-pocket premium would be to cover that. Yep, perfect. All right, so those kind of were the highlights from your insurance policies. Any questions with regards to any of those recommendations that I've made? Yep, definitely a lot. So take your time reviewing them. All right, perfect. All right, so let's move on to the second part. And this was a review of your investment portfolio. I think my first question is, tell me a little bit of your thinking with regards to the stock portfolio. Yep, the 4 stocks. Okay. Okay. All right. All valid reasons to purchase a stock. Yep. Now, what I will say is my concern with regard is that it's not well diversified. And in fact, if I look at your stocks B, C, and D, they've had annual returns of 2.1, 3.4, and 8.7% respectively. And you're actually sitting on a $218,000 loss with stock A. So that's a lot of sort of your investment portfolio allocated to just those 4 stocks. I think if you're still, yep, definitely. I'd probably recommend, if you do want to keep investing in those companies because you believe in them and you think they've got great potential, stay invested. I would just suggest a much smaller allocation to that, and not have so much of your net worth. Yep. So much of your investment invested in them. Yep. I've heard 10% before, so we can definitely, but I would definitely recommend reducing sort of your exposure to just those 4 accounts. We could actually sort of realize some harvesting of that tax loss to diversify into a more growth-oriented portfolio. In fact, I would recommend, based on sort of your guys' tax rate, a more growth-oriented fund, along with some municipal bonds. Yep. Yes, municipal bonds are tax-free. And in fact, I've put in some examples. I've actually also put in some specific New Jersey municipal bonds as well, given that you guys live in New Jersey. Not only would you recognize tax savings at a federal level, if you are interested in some of those New Jersey-based municipal bonds, you can also recognize sort of state income tax savings as well. Yep. Yeah, so I would definitely recommend sort of re-diversifying that into more long-term growth and municipal bonds. I would also recommend reinvesting your interest and dividend income. Yep, you're just taking it as cash today. You're actually paying ordinary income tax on those. If you actually invest them and reinvest them into more growth-oriented mutual funds, you sort of convert that more over to capital gains and away from ordinary income. Yep, and the municipal bonds are tax-free from a federal perspective, and state tax-free too. If you do decide to invest in some of the New Jersey-based municipal bonds. Yep, and I would definitely recommend reinvesting dividends going forward. All right, perfect. The other highlight, or the other area I wanted to highlight was with regard to, John, your 401k fund. Right now, you're invested in just a single large cap blended fund. I would actually recommend a target dated fund similar to Mary's 403b. Gives you a little bit more diversification, and those target funds actually get more conservative as you guys get older. And in fact, if you pick one right now, it would be relatively conservative, which is where you want to go. Perfect. So again, I would definitely kind of recommend moving that to a target dated fund if you're comfortable with the one that she's invested in. I'm not sure if your 401k offers the same mutual funds as Mary's 403, but I'm sure, actually, from reviewing them, it had very similar ones. So we just want to pick a comparable target retirement fund. And I actually put a couple examples, a couple options into your account, both a target retirement fund as well as an allocation portfolio of the stocks and bond funds that closely resemble Mary's target retirement fund. Yep, you can review those ones offline. Now, I also noticed that you guys each have the beneficiary set up as yourself on your 401k and your 403b. I'm actually going to recommend that you change the beneficiary to each other. By having yourselves listed as your beneficiary, if you would pass away, that 401k and that 403b would actually go through probate. So it would be dictated by your will. If you change the beneficiary to each other, basically control will just pass to each other. And exactly. Yep, if you passed away, Mary would have control of the funds right away. Yep, you definitely don't want them going through probate. Perfect. Why? Because there's certain fees that they're basically probate fees that occur. So a lot of times when you go through probate, the cost of that is dependent on how large the estate is. So the larger the estate, the higher in probate fees that you pay. So our goal, and I'm actually going to talk about that a little bit in the next section, is to reduce the estate as much as possible so that you can reduce those probate fees. Yep. Perfect. All right, well that was a perfect segue into the last topic I wanted to discuss with you guys, and that was estate planning. So again, from reviewing kind of your guys' situation, your estate is subject to what I would say is excessive probate fees and expenses. I've talked a little bit about adding a transfer on death beneficiary to your CD account to bring that down. Transferring beneficiaries, changing the beneficiaries also takes those assets out of having to go through probate. I also noticed that you did not have beneficiaries set up for either your stock or mutual fund accounts. Was that? No, you didn't think about that? Yeah, so I would also recommend setting up primary and secondary beneficiaries for your stock and mutual funds. That way, they avoid having to go through probate. If anything would happen, heaven forbid, to either one of you, your beneficiaries would gain control of those accounts. The other point I made, another thing I noticed, was the vacation home in Vermont. I would recommend retitling that as a tenancy by the entirety. Right now, it's just in your name, John. The fact that's in Vermont would actually force Mary to have to go into ancillary probate. Not only would she have to go into probate within New Jersey, she would have to go through the whole process again in Vermont in order for that house to pass over to her. No, you don't want that to happen. If you actually title it as tenancy by the entirety, it's sort of like joint ownership. If you would pass away first, John, control of it would pass to Mary, and then vice versa. You would not have to go through ancillary probate in Vermont, something we definitely want to avoid. Yep, definitely. The other recommendation I was going to make regards some of your assets. Like the 1918 inverted Jenny stamp. I would ask that you consider transferring some of these assets into a revocable trust. Basically, instead of you guys owning it, the trust would own it. You would still maintain full control of the assets that you would put in a revocable trust. So you would still have full control. It would just be the trust owns it instead of you. You could dissolve the trust at any time. That's the whole revocable nature of it. You would be able to identify beneficiaries for anything that you place in the trust. So if you would put the stamp into the trust, you could set Mary as the beneficiary of that trust, and then it would just pass to her by action of law. It would not have to go through probate. And again, we want to keep your assets low so that you don't have excessive probate fees. So again, I would recommend transfer. It costs a little bit to set up the trust. You have to set that up first, so you'd have to consult a lawyer. Then you would transfer the assets into the revocable trust and then set the beneficiary. Correct. Yep. Technically, it would still be as if you owned it, but the trust would own it. But you would be able to then set Mary up as the beneficiary for the whole trust. And then you could set your kids up as secondary beneficiaries as well. Yep, that's the primary downside would be the cost and the complexity of setting up. You would have to consult with a lawyer. Yep, a real estate lawyer to make sure. Yep. Yes, because probate fees are based on the size of the estate going through probate. So we want to try to reduce as many assets going through probate as possible to keep those expenses down. Yep. Perfect. And most importantly, and this is from an estate planning perspective, this is the most important thing. There appears to be no power of attorney or healthcare proxy set up for either one of you. These are critical to manage both your financial and health affairs in case you get incapacitated. So suppose you have a stroke and you are unable to talk. This is what happened to my grandfather. He was super healthy, took care of everything, and then he had a stroke. Or a car accident. If both of you got into a car accident, we want to make sure we have plans in place for someone to manage both your financial situation, your financial affairs, as well as make any health decisions if you can't speak for you. Yep, I know. Nope, you would actually talk to an estate planning attorney to set those documents up as well. If you talk to an estate planning attorney with regards to the trust, then they can also help you with both the financial power of attorney, a healthcare power of attorney, and then a healthcare proxy as well. Yes, I think this is, especially as you guys are now in retirement, I think, do you really want to leave that up to chance? Like I said, I always use the example that happened to my grandparents. A stroke could happen at any time. Yep. And if something happened to both of you guys, we'd want to make sure that we had everything. Otherwise, we have to go. Your family would have to go to court. They'd have to have the court. Yep. Yes. Yes. It helps out and makes things a lot easier on them if something, heaven forbid, happened. All right. Perfect. Well, those were the highlights I wanted to focus on today. We covered a lot. Any questions? Anything with the insurance policies? Anything with the investment accounts? Yep, we put in a asset allocation into the documents, one that I'd recommend. Again, kind of growth-oriented stocks, municipal bonds, a little bit international exposure. Yep, exactly that. I covered the installment. The funds from the sale of your business. I've got those kind of laid out too, because I know you wanted to invest those. Yep, and then any questions from an estate planning perspective. Again, I think our focus should be on reducing the value of the estate that has to go through probate. And then, most importantly, you want to set up those financial power of attorneys and those healthcare proxies. All right, any other questions? All right, well, we covered a lot. And if you turn to the last page, I actually put together sort of an action plan to try and keep everything organized. So let's kind of go through that here quick. Nope. Okay, perfect. Okay. All right. So I always like to start sort of my action plan out with quick wins. I like feeling a sense of accomplishment. So I'm starting out with a quick win. And to me, I think the quick win here is basically to go change the beneficiaries on your 401k and your 403b to each other. You can just log right into your accounts to do that. It's all done online. And you can actually do that today when you get home. You can log into your accounts, set each other up as the beneficiary. And John, while you're logged in, you can also, in that session, reallocate your 401k to a target fund similar to Mary's. So you can actually get a twofer. You can set up the beneficiary as Mary, and you can transfer that long-term, long-term capital gains. It was that large cap blended fund to a target fund. So you can knock two out with one. Yep. So that to me is the quick win. That's the easy thing. Second, under the action plan, I'm recommending you visit with an estate planning attorney as soon as possible to obtain proper estate planning documents. You can also talk about the revocable trust. So again, you can knock out a couple of the things on there by setting up that meeting with the estate planning attorney. All right, perfect. Now, here's the thing. Who wants to take point on that? All right, John, you're on point for that one. And when do you think you can get to that? I always like having sort of a milestone date out there that then I can kind of check up with you. Make sure that it happens. Oh, I trust you, but it also, yep, exactly. So when do you think you can set up that appointment with the real estate attorney? Okay, within 2 weeks? All right, I'm gonna write that down and I'm gonna follow up with you in 2 weeks. All right. Second thing on the action plan is addressing the insurance policies. This is increasing the coverage on the home. Most importantly, getting a policy set up for the inverted Jenny stamp. And then the umbrella policy. I think, again, there's a lot of risk there too. I'm highlighting the umbrella policy as something to do as well. And then finally, if you do want to get a long-term care policy, you can do that as well. So basically number 2 is calling your insurance agent to kind of deal with those things. So who would like to run point on that? You are Mary? Okay, perfect. So Mary, same question. When do you think you can get to that? Yep, there's a lot to review. And a lot of, yep. Okay, by the end of the month? Okay, end of the month. Perfect. And again, I'll check in just to make sure. Yep, all right. So you each got one. There's a little bit of urgency to the third one, and this is your Medicare policy. So again, this is addressing sort of the gaps in your existing coverage. There's a little bit of urgency in this because we are in annual enrollment. Oh, Mary, you're going to take that one too? Okay, you've got the insurance ones? All right. So again, really the decision you need to make is whether you want to go down the Medicare supplemental route or whether you want to bundle all 4 of those into a Medicare Advantage policy. And again, I put some in there as well, but when you call your, yep, you did use a broker. I think you said you used a broker. Yep. When you call him, he can walk through different options as well if you're comfortable working with your Medicare insurance broker. Yep, perfect. Okay, so you'll get that done within a couple weeks? All right, just remember there's an expiration date next year. You've got to get it done. Okay, 2 weeks. I'm writing down 2 weeks. Okay, so within 2 weeks you're going to call about Medicare, and then within 4 weeks you're going to call your, yep, on the property insurance. Okay, so you got a 2 and a 4. And then finally was diversifying your stock and bond portfolio. So this is sort of reducing your exposure to the 4 stocks. I did include an asset allocation recommendation in your accounts. Yep. Definitely review that. So John, I'm hearing you're going to take point on that one. All right. So John, when do you think you can get that done? 2, 3. Okay. 4 weeks? Okay, I like that. So there's a little bit of symmetry here. So you each have a takeaway that is going to be executed on within 2 weeks, and then you each have a takeaway that'll be executed on within 4 weeks. So John, yep, you got the estate planning attorney and the investment accounts, correct? And you've got the insurance. All right, that makes it easy. So let me ask you, are you guys, any objections or any concerns with any of the recommendations that I've made? Or are there any changes that you'd like to make to anything that we've talked about today? No? Okay, perfect. Well, what I'm going to do is I'm going to give you a statement to sign at the end of our meeting here, just to make sure that you guys accept these recommendations. All right? Perfect. And yep, we've got some things to fill out there as well. All right? Perfect. Well, guys, that was the hard part. Right? The hard part's behind you. We've done it. There's a little bit more to review within your guys' financial plan. So again, I'd recommend you guys go through that in detail. Again, I've summarized sort of the high points at the end. Your job now, going forward, is to continue to ask me questions. Anything that doesn't make sense, anything that you forget or don't recall, anything you want to chat about, please reach out to me either via email or you've got my phone number. If I don't answer, just leave a message. I will get back to you within 24 hours. So that's sort of the first job. The second one is let me know if there are any changes to your financial circumstances. Again, I view these as living documents. Market conditions change, your guys' goals and priorities change, sort of financial situations change. So anything that you think material or even immaterial don't impacts the financial plan, please let me know. I have no problems pulling together kind of a review of that event, and of course, always willing to meet with you guys face to face. Perfect. Any questions? Excellent. Well, Mary, John, it was great seeing you guys again. If you want, we can deal with some of the paperwork right now. So, all right. Thanks a lot, guys. Have a nice day. Thank you.